the Bitcoin stuff was obviously a huge example where,
hold on,
they're
Justin.
having conferences in the Bahamas and Bitcoin's in stage 4 getting decimated at the same time. Like, what's going on here? Like,
I just started the recording, so
okay.
Hey guys, let's talk. That's why we're gonna retouch on what we just said before the recording start. Justin, hi guys, NorthstarBadcharts, Kevin Wadsworth, myself, and of course it's been a little while. We had Justin a few times on. Justin Smythe from the NextBigTrade.com. Very happy to catch up with you, Justin. And right before this call started, yeah, like I was telling you, like I'm kind of at war with fundamentals because for me, fundamentals will always be after price, or price is always, we trade price, for crying out loud. It's so simple in my mind. It's like when I click the buy button, I'm not buying a price to earnings ratio. I'm buying and selling a price. So for me, the rest is like, I'd rather spend time with my family than go. Like I talked to some fundamental guys and, oh, Patrick, man, they spend countless of hours trying to dissect what all these, whatever fundamental guys do. And I said, I discovered TA and I just like threw that away. So I know you're a pure price guy, and maybe you could tell everybody there how you came to that conclusion that works best for you.
Yeah, I mean, my journey involved reading a lot of fundamental books about the stock market. I know in colleges they teach like valuation analysis on equities and a lot of things that I got an engineering degree, but I mean, I know they study that, and I started reading about that after I got out of college because I was interested in trading stocks, and I actually tried to use that to trade myself, and I found that the results were extremely mixed and not consistent. And when price disagreed with me, I didn't understand why, because the fundamental analysis would give you a good story about why things should work the way they do. So then I, branched over to technical analysis and eventually found Stan Weinstein's book. And once I started using the stage analysis method and seeing it work, more consistently than the fundamental method, it really became apparent to me that this is a better system and I should use this versus trying the fundamental method. And then another thing I had to do was, I read a lot of books about trading that covered a lot of different topics, macro and other things that were all leaking into my overall analysis of the market. I had to remove almost everything else that I had learned that was poisoning my stage analysis method and really just focus on stage analysis, because stage analysis by itself, I really think, is all you need, or some type of method that follows price and volume to trade the markets and find stocks that are actually breaking out into uptrends or breaking down into downtrends, and being aligned with price and volume is all you really need. But I don't think the fundamental thing is ever going to go away, because so many people want to try to figure out why things are happening. And so it's always going to be there. But fortunately, we have other methods of analyzing stocks and trying to.
There's a very, very clear sort of way of explaining that a lot of people might perhaps understand. And that's looking at cryptos, of course. I mean, the fundamental utility or the fundamental story for cryptocurrencies hasn't changed. The arguments that people put forward for why cryptos are the way forwards, today are the same as they were a year ago, 18 months ago. That the fundamentals behind cryptos, nothing's changed, and yet the prices have fallen between 75 and 100%. I think I saw today that 3,000 cryptos have been listed on one of the crypto listings there. 3,000 of them just don't exist anymore. So a lot of the tiny cryptocurrencies and altcoin, they just completely vanished, and that that's enough to wipe people out. So whilst the fundamentals might not have changed, if you use the charts instead, if you'd use technical analysis, then you wouldn't have got caught up in all of that. You'd have exited all of that right at the start of this year. You'd have seen the breakdowns. You'd have seen the moves below the 3-year moving average, below the 30-week moving average, as Stan Weinstein talks about. You'd have seen the topping process unfolding just exactly as Stan Weinstein said. The breakdown, the back test of the breakdown. You would have exited and avoided all of that. And that's what technical analysis gives you. So it's a map. You can see the map, being drawn in front of you. And that just takes away all of the need for the fundamental discussion, because you can argue all you like about the fundamentals. It doesn't change what the price is doing.
Exactly. Yeah. And like you said, this stuff happened back in late 2021 when Bitcoin started breaking down and went into stage 4 a long time ago. The number one rule in stage analysis is don't hold anything in stage 4, because that's where you can really get decimated as it keeps moving lower and lower over a long period of time.
Well, exactly. I mean,
Tesla
or Apple or Meta, all of these stocks.
Right.
It's exactly so. All these tech stocks, they went into stage 4 decline, more or less at the same time, and exactly the same stage analysis techniques. If you haven't read Stan Weinstein, by the way, people that are watching this, I'm joking about it, but as Justin says, you've got to read it. It really does open your eyes.
Right, and aligning yourself with these trends is where you make big money in these cycles, or where you lose big money. So unfortunately, stage 4 has been present in almost everything this year, and a lot of losses have been generated because of that. But it doesn't mean stage 4 is going to last forever either. I mean, there's already things that are starting to base out and move back into uptrends. And there's lots of basing action overall, I think, in the market right now. So these things always change. And so if you have a fundamental fixed viewpoint that never changes, the price action is going to go through these cycles regardless of what your fundamental opinion is. And if you're on the wrong side of one of those cycles, that's where you really get hurt. Or if you're on the right side, if you were, long Bitcoin or Tesla in 2020, that's where the money was made. But then the cycle topped out and rolled over. So,
man, yeah, that's the most dangerous thing that could happen to a new investor, a fundamental guy. He gets in the market, he has a fundamental story that he adheres to, and it just happens he's getting in when it's a stage 2 breakout. And that guy thinks it's his fundamental thing,
right,
driving everything. And that's the death trap, because he's going to give everything back. Just like you said, he's going to go to stage 4 and he's going to say, like Kevin said, the fundamentals didn't change. The market's wrong. It's going to go back up. And then it goes down and down and down. And he gives up at the exact bottom where it's basing.
Yeah. I mean, unfortunately, what happens to people too is like you said, they catch a stage 2 because of fundamentals or not. They get so excited by the time it starts to top in stage 3, they can't sell and take profits, and they start holding it while it rolls over and starts moving back lower, and they lose everything because they're so excited about all the money they just made, and they think they're going to make more, but they can't change that psychology and say, oh, it's topped out, it's rolling over now, I need to get out, take the profits, and move on to something else.
So would you agree with this? Is something that I think a lot of people think about a lot of the time. It's all very well to talk about stage analysis, but it's the exiting and knowing when to exit that a lot of people sort of say, great, okay, so you spotted the breakout, you buy the breakout, now tell me where to exit. And one of the things I keep saying to people is, that people seem to have it in their mind that it's important to catch the bottom and exit at the top. That's right. completely and utterly wrong, because there's nothing in technical analysis or anything else that is going to tell you when you've hit that exact bottom. You might get an exhaustion candle. That might be perhaps a good indication, for example. There are some sort of slight indications, but you can then from that point, you can carry on building a base for 2 years. You could buy in at what you think is the bottom. You get a nice little move up, and then you end up going to the same sort of level or even a little bit lower, and then it goes sideways for a couple of years. So what I'm saying is that it's not about catching the bottom. It's about knowing when there's enough evidence, enough technical evidence to give you a higher level of confidence that the price action is now reliably moving to the upside. And then once you've identified that, scaling in, getting in, taking your position, and then identifying, as you just said, the stage 4 decline when that process begins. Can you just describe for people that are watching how to spot that topping process, the typical sort of giveaway signs that you're topping?
Yeah. Do you want to pull up a chart of Bitcoin, or I can pull it up too?
Yeah, we'll let you share your screen and show the stage analysis magic.
Sure. Let me see.
You're right. Yeah, share. Are you on a Mac?
Oh, here it is. Yeah. Share the screen right here. Okay, so I'm sharing Bitcoin, I think, right here, right?
Okay, yeah, it's just coming up on the screen now. Yeah, that's it.
Okay. Yeah, so if you look at what happened in November of 2022, you've got a failed breakout higher here where the price tried to push above, 55,000 or so on Bitcoin, and then there's a big red candle that came back down lower, right below the breakout level, And from there, it started to trend below the 10-week moving average, which is the first kind of warning sign. And then eventually, by late 2021, it starts topping out around the 30-week moving average, and then it falls below it for the first time, or since like the middle of 2021. And then it continues lower, and we saw a retest of the moving average back in April of 2022. It fails there and then just continues lower. So it's by then it's confirmed stage 4. I mean, it already rolled into stage 4 in early 2022, but it confirmed the breakdown on that first retest of the moving average and failure again. So I mean, basically from the point of early to late 2021 to early 2022, you should not have been in Bitcoin anymore, and you would have avoided 70% of losses because you're out of a stage 4 market there.
I think it's also worth, some people are probably looking at that chart and thinking, yeah, but it also peaked at around about whatever it was, 60,000 in 2021 there, that earlier peak. And the point to note is that if you'd been using Stan Weinstein's stage analysis, you would probably have exited on that red candle that went down below the 30-week. Is that the weekly chart? So it's the blue line is the 30-week, isn't it?
Yeah, that's the weekly chart, exactly. Yeah.
So that 30-week moving average candle, when that came down below 40,000, that would have been one signal to exit. But also the 10-week there, the red line, in a strong uptrend, when you're going not necessarily sort of parabolic, but when you're getting that very, very strong bull market move and you're getting very far stretched away from the moving averages, a break below the 10-week moving average there is quite a strong sort of indication, because it was giving very good support all the way up there. And that early sort of breakdown at around about 55,000 in April, May of 2021, if you had exited at that point there, having ridden the move up, if you just turned your back on cryptos at that point, moved away and recycled those profits into something else that was in an early stage breakout, stage 1 breakout,
stage 2
stage 2 breakout,
sorry, I beg your pardon, stage 2 breakout, then you would have been able to ride that similar move up in another asset class. So it's that psychology of exiting and not having that fear that should I get back in, should I, because it came down and then it moved back up from 35,000 to 69,000, and the temptation would have been to sort of get drawn in at some point. You could have maybe sort of looked at it at 45, 50,000 and decided to get back in, and then you end up getting chopped around all over the place. So I suppose what I'm trying to say here is that once you've caught that chunk of that move and not been too greedy about it, you have to have no regrets. You take your profits and you move on to something else, because that market at that stage has done its thing. And even though it came back and put in a nominal higher high, there was not really a lot of point in starting all over again when you could have moved to another asset class that was right at the very beginning on a stage 2 breakout.
And it only went into stage 3 as well in mid 2021. So you could have bought the breakout again above the moving average and caught some of that move up to, the former high again. And there was another, let me show you like Solana. So what happened really, Bitcoin was the leader in, starting in 2020, Bitcoin was the leader. And then what happens in these big bull moves is the smaller cap stuff and the more speculative stuff tends to really surge at the later phases of these big sector moves. And that's exactly what happened with crypto from 2020 to 2021. The alternative crypto went parabolic in mid 2021, and there was more trading opportunities to trade alternative crypto. This is one of the greatest examples. Solana, breaks out later than Bitcoin, and then has a continuation move in August of 2021, which, was a very profitable move to trade. But it tops out around the same time as Bitcoin, and then, falls below the moving average and never regains it and just moves back into a downtrend. So this happened in a lot of cryptocurrencies in 2021, where, all these alt cryptos were the more speculative portion of the move. And this is
tricky, isn't it? Because the moving averages there, when you look at them, by the time you get the signal and you move below, say, the 30-week moving average, because you're so far stretched above it, you would have, you'd have gone from 250 all the way down to about, well, less than half of that by the time you get the sort of sell signal by going below the 30-week moving average. And this is a difficulty with micro cap stocks and cryptos when they can move so rapidly. You have to start using shorter period moving averages. That 30-week moving average is just so far below the price that in this case, the 10-week moving average is more applicable. And so, as you get those sort of parabolic blow off tops, you need to learn to recognize that and use a shorter moving average.
Yes, and you can also develop what I call selling into strength and selling into weakness rules. You can develop, like, there's rules where, like, the swing high up here, where you get a couple red candles on the weekly on heavy volume, that could be a sell into strength rule, and especially if you break a shorter term moving average. And then you can, like, you don't have to do everything in one trade. Take partial profits on selling into strength, hold some more of the position for a longer term move, and then maybe your last sell is that sell into weakness on the break of the 30-week, where you're just getting out because it's breaking the long-term trend, and then you're totally out at that point. But you don't have to wait with your full position until the end of the break of the 30-week moving average. And
how are you?
Like, you need to. This is why stage analysis is so important. Like, you need to buy at the stage 2 breakout, which was back in early August, because if you are chasing late, that's where you get trapped, because you're buying too late in the uptrend, and it's going to top out, and you're not going to be able to take any profits. So that's why finding these breakouts is super critical to using this method. And that's what I've been focusing on with all my content and stuff like that on the internet. So
I'm wondering, like, this is another example why fundamentals, I don't care, because you could put that Solana chart, you could put any crypto chart, you could put the cannabis stocks. I looked at CGC, it's or FedEx. They all have these same patterns. It's like, and people think fundamentals matter. These are different companies, different CEOs, different asset classes. But at the end of the day, guys, all the blow off tops, all the ones that went parabolic, they all look like that. Blow off top, echo bubble. So that small bubble in March of 2022, that fails. It's game over after that. It's game, like, that was your last chance to exit. Was if as soon as you see that echo bubble fell, it's like there's no more juice in that for those instruments.
And that's why you have to learn from people like Stan Weinstein, because they were doing this for so many years, and they spotted these technical chart patterns that repeat over and over again. And you can put your hand over the ticker in the top left hand corner. Just ignore the ticker. It doesn't. In my view, it barely matters what the ticker is. The only reason it matters to me is whether it's a micro cap stock or a mega cap stock, because it can make the buying and selling a little bit trickier. It can be hard to exit at the price that you want to exit at if you've got a micro cap stock that's falling at 30% in one day, for example. You put your sell order in, and you can't sell it when you want to. So that from that point of view it matters. But from a technical chart analysis point of view, the ticker in the top left hand corner makes absolutely no difference. As Pat says, the charts all behave the same. Doesn't matter what the fundamental story is behind the companies. I mean, just look at the big tech stocks at the moment. They're crashing down, and these are good companies. They've got good fundamentals. They've got good lots of good reasons why they should do very, very well over the next 10, 20 years. And yet they're still losing 40, 50, 60, 70% of their market valuation. So just seriously, the fundamentals, makes very little difference at the end of the day. And it works the same in reverse as well, because all the crappy stuff in a strong bull market, it lifts all the crappy stuff up as well. In fact, some of the crappy stuff goes up even greater in percentage terms. Just look at some of the silver, some of the explorer precious metals explorers. They might not even have a mining permit. They haven't even got a business haven't even got a sound business, but they'll go up by 5,000% or something. So it works in reverse as well.
Yeah, I mean, look at Amazon right here. Another example. You got a stage 3 that's starting to form in late 2021. It rolls over below the moving averages. It retests the 30-week in March, and then rolls over again, retests again in August, rolls over again. I mean, we've been in stage 4 for a while now, so a lot of people know about this bear market by now, but yeah, clearly another example of different asset, but the same transitions into stage 3 and stage 4 that we saw in Bitcoin. And you're exactly right. This analysis applies to any market. Doesn't matter if it's commodities, stocks, bonds, currencies. You can trade anything with stage analysis. And that's another reason why I love the system, is that I can trade all these different markets using the same principles and not have to change what I'm doing at all. One of the things,
I was just going to say, I can give you another example of the stupidity of fundamentals as well, because I put a chart out a year ago in December that showed the extreme energy costs in Europe, and the fact that they had broken out and using Stan Weinstein's methodology, very, very clear breakouts, and raw energy costs across Europe were 3, 4, 5 times the historic average, and the mainstream media was completely silent at the time. There wasn't no mention of it in the mainstream news. And then 3 months later, Russia invades Ukraine, and guess what? The high energy prices are because of the war in Ukraine. Well, no, that's not. This fundamental story came along, this narrative that explained something that had already been going on for months. As I say, I agree with Patrick. I agree with you. Justin, fundamentals are just an excuse that come along to explain price action.
Yeah, and sometimes their timing is good, and other times their timing is awful. So, when their timing is good, they'll really focus on it and be like, "Oh, I predicted this move because I had this great theory about the fundamentals, and it turned out to be correct." And then if they time it wrong the next time, maybe they go quiet about it because it just happened that they were completely wrong. But whatever the markets are going to do, whatever they want to do in their cycles, and it doesn't matter what the fundamentals or what people think the fundamentals are.
And of course, in a bull market, it doesn't matter what the fundamentals are. You can spin a good story, and you're going to be right, aren't you? Because you're in a bull market. Right. So, and then it goes a bit quiet in the bear market, of course.
Here's the Chinese internet ETF. I've been talking about this a lot. I've got a new premium newsletter on my website too. It's premium.nextbigtrade.com. And the first couple issues, I've been talking a lot about China because China went into stage 4 a lot earlier than a lot of other markets. China went into stage 4 in early 2021 versus a lot of markets didn't top out until late 2021 and early 2022. And China actually bottomed. You can see in this chart, a first major bottom was in March of this year, where a huge amount of volume came into this ETF and a lot of individual stocks starting to kind of put in a bottom into place. And then we retested that bottom in late October 2022, pretty recently. There's a lot of volume down there again. And then coming off of that bottom, we've seen consistently week after week after week of an increase of volume again, kind of rounding out this basing activity. And some of these individual stocks have now pushed into stage 2 and are taking volume and are not giving back their gains on their initial rally. So here's an example of a sector that's starting to transition into a new uptrend potentially. And while everything else is still, in stage 4 and still mired in this bear market. And if you look at the longer term chart, which this even makes me even more excited about this sector in particular, is that the U.S. stocks have really outperformed a lot of other asset classes for the last 10 plus years. The FANG stocks are really a great example, where Apple, Amazon, Meta, all these stocks went up for a long period of time while other asset classes were ignored. And this created these large sideways basing formations in these things. And I think China tried to break out in 2020 out of this big basing pattern. And obviously with the things going on there, it failed and entered stage 4 again. But, look at the volume that's come into this in the back half of 2021 and even into 2022. It's just consistently huge volume. I think there's probably a lot of institutions that are, getting super involved in this sector. And, I think this could be really an explosive move coming out of this base at some point, probably starting next year. So I'm definitely keyed in on this sector. And there's a few other ones that have showed some relative strength too. If you look at healthcare, the XLV has really showed tremendous strength during this bear market. It's sitting close to high still, and it's actually starting to hold support at the 10-week moving average now. So, and look at the relative strength against the S&P 500 on this middle part of the chart here. So, I mean, lots of outperformance, and there's a lot of biotech stocks right now that are breaking out into stage 2, along with this healthcare move. So, a couple of sectors that are looking interesting to me right now. We can look at the metals too if you want.
Yeah, Justin, before you move on, so you're not using the Mansfield relative strength, but you plotted the ratio chart, the actual ratio chart.
Correct. Yeah, I just used the ratio down there. I think it's pretty easy just to compare right against the S&P 500, and you've got like a 40-week moving average as the blue line. So basically, whenever the black line is above the blue line, that means that this market is outperforming the S&P 500. So this went into an uptrend in February of 2022 and has been there ever since. So healthcare has been a relative strength outperformer against the S&P 500 for almost this entire year. And typically when new cycles start, whatever's showing a lot of relative strength coming out of the bear market, that's going to be your next leader. So this is a good sign that stocks in this sector are going to outperform the markets whenever we get out of this bear market.
So in other words, what you're saying is that, I mean, if you step back and take a look at the XLV chart there, really for the last year or so, it's effectively gone sideways, but it's outperforming the S&P because the S&P has gone down. So
correct.
In other words, yeah, as you say, XLV has shown relative strength by holding its ground whilst the S&P as a whole is being dragged down by other sectors, particularly, tech, for example. So when the S&P begins to actually turn a corner and the S&P as a whole starts to rise, then XLV there is really well poised to outperform. Yeah.
Right. See, XLV has no resistance now. So once it breaks out, it can start moving higher with no price resistance. Whereas all these FANG stocks, like Tesla's an example here, Tesla is underperforming the S&P 500 tremendously and now is buried underneath all of this resistance.
Yeah.
So even if it rallies back to resistance, it's going to have to fight its way back through that price action to make new highs, whereas healthcare doesn't have to do that. And China has already cleared out most of its resistance because it's already been basing for almost a year now. So you've got a year's worth of resistance cleared out on China now, but you have immediate overhead supply in Tesla and all these FANG stocks.
Yeah, those ratio charts are really useful, aren't they? Yeah.
Right.
Yeah, good stuff.
Yeah, so I would expect tech to underperform. There will be a big rally off of these bottoms, but over the longer term, it should underperform in the next cycle, and other assets will tend to outperform. I would expect probably China and healthcare to be two of them. Commodities have held up pretty well during this bear market as well. So, and gold and silver have both kind of moved back into stage 2. They don't really have the volume yet that I'd really like to see on these moves higher. So, that's been lacking, but that might come in later potentially. And I think silver in particular, if you look at a longer term chart of silver, once it gets back above the mid 20s, it really has no overhead supply above it either. So, and you've got a huge 10-year base, just like China in this market. So I think this could be set up to break out
Justin,
next year at some point.
What's the PPO indicator you have in the bottom pane?
Yeah, that's the distance from the 30-week moving average.
Okay.
So a lot of times you can use this and go back to different periods in the past and see how stretched the market can get from the 30-week moving average. And that can give you a sense of, when to take profits potentially in these big moves higher, because it's super stretched above the moving average when the market starts to take off. So it's just a general guideline of how stretched both to the upside and downside something can typically get before you get a a pullback, type of move. And typically it varies with market capitalization, where these small cap stocks can really get stretched a couple 100% above the moving average, whereas the larger cap stocks, kind of like what Kevin said, there's so much money inside of them that they can only get stretched to a certain point before they can pull back and stuff. So, you can develop rules based around the market capitalization.
I think a lot of that's to do with, the institutional money that is there and is what you could refer to as strong hands, I suppose. So you've got a core of investment within those big mega cap stocks that is, in a sense, always going to be there. But without that, if your micro cap stock is reliant on private investors, then they can pull their money at any moment they want to and cause the share price to crash overnight. It's kind of common sense if you just kind of pause and think about what's what the dynamics are.
Right, exactly. Jumping down to a daily chart of one of these China stocks, if you look at how some of these are behaving right now, the price action is really tight, like around after the breakout. I mean, this is the type of price action that tends to happen when a new uptrend starts, where the pullbacks are very shallow because there's always buying pressure coming in to get into the stock out of the initial breakout. So if you see like these tight, like I think Mark Minervini calls it tennis ball action, where the stock, if you were to push it down underneath water with like a tennis ball and it just like pops back up, that's how these stocks tend to behave coming out of these breakouts. And that's a good sign to see across multiple stocks in the sector. So I think we're seeing an early sector move here. Just we'll have to see. This overall bear market is going to impact everything still, I think. So if we're still in a bear market into next year, maybe the China stocks still need to consolidate for a little bit longer, but they're behaving pretty well so far coming out of this breakout. So we'll see what happens. And another thing I've been looking at too is the Dow Jones Industrial Average versus the other indexes. And the Dow is more weighted in healthcare stocks and doesn't have the heavy market capitalization weighting of all these FANG stocks that are weighing everything down. And the Dow is actually trying to establish support potentially at the 30-week now. We'll see what happens on this pullback. But given the fact that the Dow is so much different than everything else, you're just seeing a lot different type of relationship between the moving averages and the Dow right now than the S&P 500 or these other market capitalization weighted indexes.
Interesting, isn't it? Yeah, I've been watching the Dow as well, and it is, it's clearly outperforming the S&P, but it'll send a strong signal if that rolls over as well. That's for sure, because it has been showing that relative strength.
Right.
So, I mean, the moves that are taking place in NASDAQ and starting to show themselves in the S&P are, they're of historical significance. I think these type of breakdowns, especially versus inflation. If you plot the charts of S&P and NASDAQ versus inflation, they're giving signals that they've only given on three previous occasions since World War One. Since in the last 100 years, the signals that we're starting to get now from the S&P and the NASDAQ versus inflation, we've only seen 3 times in the last 100 years. So if these signals are confirmed over the next month or so, well, what happened on the 3 previous occasions is that versus inflation, it took between 12 and 24 years to get back to where it had started. So that kind of situation is what, in my mind anyway, powers these capital flows. If hedge fund managers realize by looking at a chart like that, and I'm sure they do look at these charts, the penny starts to drop, that they're looking at a lost decade where, if they're invested in general equities, their funds are going to go nowhere at best. Then they start to hedge, they start to reallocate to commodities and precious metals, and as you say, overseas markets. And that's going to be fascinating, I think, over the next few years to watch that unfold.
Exactly. I mean, what's happened this year is a paradigm shift in the markets in terms of the FANG stocks and the large cap tech stocks in the US. They finally topped out and rolled over into stage 4. And it's almost 100% unlikely they will be the next leaders in the market because they were the last leaders for so long and they got so large that they dominated the market. But now they're underperforming. So now there's an opportunity for other portions of the market to take over leadership. And I think we're seeing some of them right now, and we'll probably see more of them as we finally get out of this bear market. We will get out of this bear market at some point. I know it's been pretty brutal this year, but as we started saying in the beginning, all these cycles always change. So don't expect any one cycle to be there in place for the long term. It always changes. Bitcoin finally went down. It's not going to go down forever either, but something else is going to be the new leader. So that's our job.
Yeah, but Justin, some stuff. Look, the indices, I agree, because they're weighted. Let's say S&P 500, it's 500 top companies. The companies that go bankrupt, they're out of the SPX. So SPX is always going to survive, but some companies never come back. They do the bell curve, and they don't have a stage 2 anymore. Some they just die, like these altcoins that Kevin was talking about. They're dead. They don't have another chance.
Exactly. That's what people need to realize is individual stocks and crypto and whatever else. Yeah, it makes a cycle. It tops out. It might never come back, which is the unfortunate reality. But that's why index investing is so popular, because indexes will always kick out the crappy stocks and replace them with the best companies in the United States. And that's why the index always survives over the long term and goes higher. But individual stocks don't do that.
It's not going to be popular to say that Bitcoin might never come back, but you have to take on board, if you're scientific about it, if you're realistic about it, is the fact that Bitcoin needs to break out. It needs to prove through evidence on its own chart that it is coming back. And because the alternative is, there's an alternative view here, and that view is that, the cryptocurrencies and Bitcoin have not had to endure a secular sort of bear market of the sort that we've only had 3 times in the last 100 years, because crypto wasn't around when that happened. So we don't really know how cryptocurrencies are going to respond to that. They could decouple and start to behave as a hedge, like that precious metals typically do. That's entirely possible, and I know that crypto fans will be expecting that, but we can't assume that. It can't be taken as a guarantee or as a 100% certainty. You have to wait for some evidence on the chart. And to my mind, Bitcoin needs to get back above its 30-week moving average, and it needs to get above its bear market defining resistance line. There's a clear resistance line from the bull market peak to where we are now, if you put it on its log chart, on its log scale. And until it breaks out above that resistance line, then for me, Bitcoin is just going to continue to suffer. You can see that sort of clear on that log scale there, that clear sort of straight line that you can join from the top to sort of where we are now. And fine, when it gets above its 30-week moving average and it starts to give some of that sort of relative strength that we're looking for the next option. But even, to be fair, even when it does get above some of those key levels, just look back at previous cycles. It can take a year, 18 months before it truly starts to make the sort of bull market move that you might want to take part in. So you have to adjust your expectations, even in the most optimistic scenario, and we get a breakout in Bitcoin and it goes above wherever the 30-week moving average is, somewhere near 20,000, I think it is now. Then it could take another year or 2 years before it really gets going. But none of that can be taken for granted. Bitcoin, for all we know, it's in a completely different macroeconomic environment, and we just don't know how it's going to respond.
Justin, how do you handle, let's say you have a stock that is in a stage 2 breakout, but it's underperforming the SPX? Does that would kind of rub me the wrong way, right? It's like something's wrong there.
Yeah, that's one of the criteria that Stan Weinstein looks at for the quality of a stage 2 breakout. You don't want to see the breakout occurring in a stock that's tremendously underperforming the S&P 500, because it typically doesn't happen, because the breakout, by the time it's breaking out, it's probably outperforming at that point. But he does talk about that in the book. Like if the relative performance line is underneath the 0 line there, then you don't want to be trading that breakout. And you want to really look at the sector too. That's so critical. You want to see other stocks in the sector doing the same thing, which is what we're seeing with the China stocks right now. Is there's been multiple breakouts across that sector. So if you see one, go ahead.
Yeah, I was just going to say something else that's always, I always look for is there something happening now that is different to what has happened in the past? So if you're making assumptions about what things might do over the next year or 2 or 5 years, examine the chart and see first if there's any warning signs there. Looking at Bitcoin there, if you put the 4-year moving average on, Bitcoin is now, because Bitcoin has a 4-year cycle, of course. So the 4-year moving average is going to have a relevance and importance. And it's interesting to note that Bitcoin is below its 4-year moving average for the first time in its history. So Bitcoin is actually doing something now that it has never done before. And that's a little bit of a warning sign for me, because as an investor, I would feel uncomfortable trying to catch a falling knife and saying, oh yeah, dollar cost average, get in now. 20,000, 19,000, 16,000, anywhere around there is a great entry point. Well, it's not a great entry point if it's going down to 1,000. Look at that chart, step back and look at that chart as a whole. You can talk to me about the halving as much as you want. Yes, we've had, these 3 cycles that have been very predictable so far, but, as halving cycles go on into the future, I find it a little bit hard to believe that this cycle is going to be as reliable and predictable, for forever kind of thing. So the fact that it's doing something now that it's never done before just makes me a little bit uncomfortable, and I wouldn't be, sort of advocating that people dollar cost average in that sort of situation. Not that I would dollar cost average anyway. It's not a methodology I happen to agree with.
Yeah, if you want really one simple rule to follow when you look at these big cycles, is that the previous leader, the last leader, is never the next leader. Especially when the leader makes a enormous move that goes crazy that everybody gets on top of. That leader has like a 0% chance of being the next leader in the markets. But the problem is you get so many followers in these bull moves after these things happen that they're convinced it's the next best thing, and they're just 100% wrong, because there's so much overhead selling pressure now. There's so many people that want to get back to even on their Bitcoin, and they're never going to get there for a long period of time.
Kevin, Justin, that's the title of the podcast.
I mean, if you look at Bitcoin here in 2017, when it topped out, it still took 3 or 4 years for it to make another big move higher again. So it still took a couple years.
In the U.S. equities bull era. The NASDAQ wasn't breaking down back then.
Right. Yes. So I mean, we're seeing a huge paradigm shift now with this bear market. There's all the leadership that was there from the FANG stocks down to Bitcoin. Those are not the leaders now. Like, the next leaders are going to be China, maybe healthcare. Silver's got this huge base that is coming out of, like there's.
I think you've got to mention the miners, haven't you? I mean, precious metals miners. Goodness gracious, they've been so terrible. What an awful investment they've been over the last, I don't know how many years. And so, if you're looking for some kind of value, the mining companies, probably not just precious metals miners, but resource miners generally, they ought to have their moment in the sun, I would think. Look, and certainly, basing it on the evidence as well, looking at some of the ratio charts of SILJ to SPX and GDXJ to SPX and those kind of things. URA, I have to mention uranium as well, because that's had its first leg up in its bull market, the URA ETF, and it's undergoing a significant consolidation pullback at the moment.
If you just look at the broad commodity index, GCC is one of those like diversified commodity indexes. We come out of a bear market in late 2020, early 2021. We've kind of completed our first major topping action in early 2022, but we're still consolidating sideways in stage 3 here underneath the moving average with some tight price action. And longer term, we're coming out of a long-term bear market still here. So there's easily potential here for this to break out higher again and, reestablish itself as a leader. And if you look at some of these individual stocks, this is a stock, not to plug my newsletter again, but I talked about this stock in particular in the first issue, and BHP is making right at all-time highs here, coming out of this bear market, diversified commodity producer, where all these other FANG stocks are destroyed underneath huge amounts of resistance. So once the market gets better here, BHP has a potential to start making new highs and start outperforming and, leading the next cycle potentially. So, that's where this paradigm shift is happening in the markets.
Something else worth mentioning as well, of course, that people talk about inflation and the US dollar, which we haven't mentioned. I mean, the DXY looks to me to be going sideways to down for quite a period of time now. It's had a significant high at 115, and that's going to be, I think anyway, a tailwind for precious metals. You can see the US dollar index there. It doesn't look promising.
No, it's in stage 3, almost getting into stage 4 already. And it was really the bull market, the place to be this year, as it was the safe haven during all of this destruction of 2022. But if you look at longer term, the US dollar is, coming out of a high, and really, all these other foreign currencies have been crushed. So, I mean, there's potential for this to be a significant high over the long term. I guess we'll find out.
Justin, how do you not classify that at stage 4? What's your what are you looking at there that's making you say it's still in stage 3?
Well, I mean, the moving average is technically just starting to roll over here, and we don't have a retest of the moving average yet to kind of confirm that it's officially failed there yet. So it's really close. I mean, it's the stage 3 and the stage 1 are probably the two hardest to, determine sometimes, because once the price action's moving around it can get kind of sloppy and stuff. But I mean, it's very close here between 3 and 4. The one thing that I always typically see too is you don't when the price moves directly through the moving average and down, that's more the exception versus the norm. When something's this strong, it typically has to kind of consolidate a little bit first before it finally rolls over into stage 4.
Yeah. So it does look like a back test is a move up, and a back test is
the echo bubble.
In fact, you can see a descending falling wedge there as well. So
if you look at ARKK, this tech innovation ETF, I mean, it was a monster winner, in 2020, and then it starts piercing the moving average. It just takes multiple months for it to finally roll over and then move into stage 4. So the US dollar, the currencies tend to make more really sharp moves though. So maybe the US dollar does just roll over here. I'm not sure, but the precious metals are already starting to benefit from that, I think.
That's another lesson, guys. Whatever that arc went up 400 or 500%, well, all it needs is a 90% move down to give everything back to the breakout line.
Right.
Yes.
Right. Even 10,000% move up, all you need is 90%, and you're practically at the bottom. And it gave everything back, this arc thing. If this is not a poster boy chart to tell people, Jesus, adhere to stage analysis, adhere to chart trading. It's that's the only thing that's going to save you, because you have that Cathy Woods averaging down, giving this horrible advice, horrible. And even if that thing would pop up by miracle and do a V-shaped recovery, it's still horrible advice buying in a stage 4 decline. That gets me rattled up, man. It's horrible.
Mm-hmm. Yeah. You're exactly right. And again, they're just saying this without any recognition of what's going on the chart and what the cycles are.
There's no evidence.
If you're dollar cost averaging on the way down there, and you're buying in at 100, you're buying in at 80, you're buying in at 70. Well, we're down at 30 now. So all that money that you put in 100, 80, 70, all the way down there, you're now down to, you've lost half of that as well. So you're just throwing your money onto a fire.
It's over. Your trading career is over, Kevin. If you follow that strategy, you think the stock market's rigged and you give up. That's what happens.
It beggars belief sometimes, doesn't it? The inflation is going on in the background, of course. And what I was just going to say is that I think people have this idea that inflation has kind of done its thing and we're coming back down. It's going to be 2%, 3%. You listen to the talking heads and the Fed, and they're all saying inflation is going to come down in a controlled manner. I doubt that somehow, and this is where I look at the 1970s as a little bit of a guide as to what we may see, because inflation came in waves in the 1970s, and there are a lot of similarities between what's been going on over the last year or so in the 1970s there, with energy crises and all that kind of stuff, inflation. So I suspect inflation is going to be harder to control, and I do think that PPI is likely to creep up, energy costs are likely to remain high, and an elevated PPI for a period of time feeds into the consumer prices index, and that of course passes on to onto inflation. So for a number of reasons, I suspect inflation is going to come back and not just behave as as some of the global central bankers would like it to.
Yeah, certainly. I mean, but again, go back to the charts. I think the message in this video is go back to the charts and respect price and volume and ignore everybody else's opinion, because they're never going to lie to you, and realize that these trends are longer term in nature. So, this bear market has taken over a year to play out, and it's been in place for a long time, but, things are always changing. So at some point, we're already starting to see some new markets potentially breaking out, and it's just always changing. So don't ever get fixated on the last cycle, and if you're more willing to trade multiple markets, you've got more opportunity to catch the next big winner. So that's where you got to be. Like, free up your mind and just try to get on the right side of the price and volume, I think.
Yeah.
That's good advice.
We could close up on that. It's like, but the fundamentals will never let you do that, because you get in love with the fundamentals. But I don't want to do a girl in the bar analogy, but like I like doing, you're a single guy, you go in the bar, are you just going to stay with the one? Or
you said you weren't going to do that analogy.
Right? It's like, but it's whatever analogy, because guys, it's your money. So you get to choose. Don't let somebody force feed something on you. You get to choose all these tickers, all that stuff. Like, especially the stuff that nobody talks about. Only charts will show you that, because it's you live in the fact we talk about Bitcoin. You look back, of course we're talking about it. It did the 100,000%. Of course we're talking about it, but it's too late, guys. Every single time we talk about something, it's too late, unless it's a chart trader that shows you the chart. Then you should pay attention. Because this K-Web thing, I wasn't even thinking about that. Now I'm going to look at it, and nobody's talking about it, but Justin's talking about it. He's talking about it in his newsletter. So it could, we, as chart traders, that's our edge, guys. We don't care about the CNBC and all these guys, because when they talk about it, they've been allegedly getting money from promotions to advertise all that stuff. It's too late. When Tom Brady talks about FTX, did you ever look at the FTX chart? I had fun looking at it. It was clear breaking down. A year ago, you should have gone out of FTX or that FTT token a year ago.
Is it gone now?
There's no reason for somebody to hold that token. I think it's FTT. Is it FTX?
Oh yeah,
that
FTX
one
token. Yeah, I mean, this thing was in stage 4. Well, let me stretch it back here. Starting in April of 2022, and even back before that, in late 2021, it started rolling over. So I mean, there started to be no reason to own this over a year ago, and especially when it's in stage 4 for like 6 or 7 months up until this disaster, there's no reason to own it. So stage analysis again gets you out of this disaster before it actually happens.
Stan Weinstein said that, says in the stage 2, it's greed builds up slowly, but in stage 4 is these disasters. It's hit the sell button, the panic button. These disasters happen. They're more prone to happen when you're in a stage 4 decline, right? These huge drops out of nowhere.
Yep. Yeah. Stage 4 is the bad place to be on the long side. And that's where, the disasters happen. That's where the big money is realizing something's wrong here. They're selling out, over time selling out. And then the bottom drops out of it in these disaster scenarios where there's fraud involved or something else, So that's what happened here.
Yeah. So stage analysis. It's crazy, man. Honestly, all these disasters, 100% of them, unless they break down, the disaster happens above the 30-week. But it's rare, because the insiders, they're already starting to create that selling pressure by getting out.
Right.
But what we could say, like, at least 98% of the time, stage analysis will get you out before the disaster happens.
Yeah, actually, I have a video on my YouTube channel about, if you're familiar with Bill Ackman, he's a famous active investor. He was involved with this stock called Valiant Pharmaceuticals, maybe like 10 or so years ago. And Valiant went into stage 4, really early while he's still buying into it. And the thing just got destroyed because they were a fraud company and he lost a ton of money in Valiant. And the whole thing could have been prevented with stage analysis. But he was still shoveling money into it while the fraud was going on and while it was in stage 4. So I go through all that in the video. That's exactly why I got into stage analysis, because it prevents you from getting involved with these, fraud scenarios.
It takes away the bias, fundamentals. And when you're listening to somebody explaining their fundamental views and opinions about why you should be buying into something, whether it's the ARK ETF or whether it's Bitcoin or Solana or whatever it is, people are coming at it with a bias. Everyone's got a built-in bias, and the technical charts take that away from you, because what you're looking at is completely unbiased. It's the pure price action, whether it's above or below the 30-week moving average. You can't input bias into that. Either it is or it isn't. And then you look at supporting evidence. You look at a ratio chart of how it's performing against the S&P. You look at some of the technical indicators, and you start to build up this picture, and it's an unbiased picture. If you keep your mind clear and you draw your support line, your bull market support line, you pay attention to whether you're in stage 1, 2, 3, or 4. These rules are relatively straightforward, and if you stick to them, at the very least, they'll save you from this kind of disaster that we're talking about here. As you've said, there's no need to get caught up in that kind of scenario.
All right, good stuff, man. Hey, Justin, we've been recording for over an hour. We're gonna have to call it quits.
Sure,
But
yeah.
That means we're gonna have to do it again because there's like so much more to talk about.
Yeah.
And
we should do it again in a couple of months, because I think obviously we're going to get out of this bear market at some point and something else is going to break out. So we'll definitely have to talk about it then.
Awesome. Guys, go follow Justin if you want to plug in your new subscriber-based website there. It's time, man. Yeah,
premium.nextbigtrade.com. That's my new weekly newsletter. I'm pretty excited. I launched that in early December. So check it out if you're interested. You can always go just to NextBigTrade.com as well. That's my main website that I've had for a long time now. Get familiar with my work and get some information on stage analysis. I think you'll be, if you like charts and you like to learn something new, I think stage analysis is a great system, and it's going to help you trade the markets. So
awesome. Very happy for you, Justin. Guys, go check out Justin's work there. I've been following him for forever there, way before this Twitter stuff there. I was aware of your website there, so good stuff, man.
Thanks,
happy
Patrick.
for you.
Yeah. Yep. Appreciate that.
All right. Ciao, guys.
Thanks,
Kevin,
guys.
you want to say something? You're good?
Goodbye.
All right, man.
You did it all. Cheers.